going to go ahead and get started here today. It's just a couple minutes after 7:30 Eastern, 6:30 Central. My name is Dr. Nicole Huff. I'm an assistant extension professor at the University of Kentucky and the extension specialist for family finance and resource management. And I am so excited to be hosting tonight's webinar. It is part one of a two-part Introduction to Investing webinar series. And so welcome. If you are new to Extension, this is brought to you by Family and Consumer Sciences Extension. We are part of Kentucky Cooperative Extension, and it is our mission to deliver research-based information to help impact and strengthen the lives of Kentucky citizens. And so thank you so much for joining us tonight. And so as we get started, I'll go over just a couple of things. All right, so the webinar, the content portion of tonight's webinar will run for about 60 minutes, maybe a little less, and it's going to be followed by a time of Q&A. And so cameras and microphones have been disabled for the webinar, so we encourage you to use the Q&A feature to enter questions for our presenter. You may have some questions already. You can go ahead and get those in the question box, or as the presentation moves along. We encourage you to put those in, and we will have a time of Q&A after. We hope that you will join us for as much as your time allows. And then check your email tomorrow. You will receive a copy of the slides and some useful links, as well as a link to tonight's recording and a link to the evaluation. And so we always value your feedback. It helps us do what we do better. All right, and this is, again, part one of a two-part series. We will join back together in 1 month for a follow-up to tonight's webinar. So we'll take the information that we learned tonight and we'll go just a little bit deeper. And so we hope that you will join us. You do have the Zoom links for both if you're a registered participant, but we'll include that in the email that we share tomorrow as well. All right, so let me introduce our presenter tonight. And so it's really my pleasure to introduce Dr. Woodrow Johnson, who is a senior financial economist in the Division of Economic and Risk Analysis at the U.S. Securities and Exchange Commission. So he has been with the SEC for more than a dozen years, and his primary focus there has been on rule writing and enforcement, particularly on matters related to mutual funds. For the last 3 years, he has served as the senior advisor to the SEC's chief economist. And before joining the SEC, Dr. Johnson was on the finance faculty of the University of Oregon and the mathematics faculty of Truman State University. He earned a master's degree in mathematics from the University of Tennessee at Knoxville, and a master's and a doctoral degree in finance from Columbia University in New York City. And so we are in good hands tonight, and it is always such a pleasure to partner with just leading industry professionals so that we can bring you that research-based information. So with that, I'm going to stop sharing my screen. I'm going to invite Dr. Johnson to share his, and welcome, Dr. Johnson. I'm going to turn it over to you.
Thank you very much, Dr. Huff. I'm really excited to be here tonight. It's really a privilege for me to speak in front of Kentucky Extension. Let me see. Hopefully you see my screen now, a PDF file. Can you see that?
Yes, we see you. We see you.
Okay, perfect. Thanks. You just went away there for a minute, had you nervous. Okay, so before I get started, I have to give a quick disclaimer, which in essence says I'm speaking today, I'm using my words. I'm not here to speak on behalf of the commission or of the SEC. I'm not here to speak for the commissioners, for the chairman. I'm not going to give you legal advice or give you policy statements or really give you any kind of official type information. Instead, think of us today as having an informal conversation. My goal is to share with you a couple of key things to think about the kind of behaviors that prudent investors have when they go to the financial markets, some of the questions they ask themselves to make sure they're making good investment decisions when they choose to invest. We'll cover a wide range of topics today in this order. We'll end, as Dr. Huff just said, with the Q&A session. So feel free either now or anytime during the presentation today to submit a question along the way. And as Dr. Huff mentioned, also my slides will be distributed through her and her staff sometime tomorrow. So with that then, let me mention, we'll come towards the end of the presentation today and talk a little bit about resources you can have for learning more about the financial markets and learning more about investing. One key resource will be investor.gov. We'll come back to this later on in the presentation today. Before we begin, though, talking formally about investments, I would like to quickly make a couple of brief comments about debt. In the US today, more so than say 50 or 100 years ago, debt is ubiquitous. It's very easy for most individuals, or for many individuals, to go and incur debt. Go to a bank, borrow money, buy a house. Go to a car dealership, borrow money, buy a car. Used car, new car, whatever. You can easily go get a credit card, and you can even put your lunch on credit and borrow money for buying lunch today. Debt is complex. I'm worried. I wonder how many people that incur debt really understand the details of that debt, the kind of liability that they take on. Credit card companies actively lobby or target a lot of audiences, a lot of younger people, college students, for example, and people that are pretty young. And I wonder, do they really know all the fees that they'll incur with that debt? And are they aware of the expenses they pay, the interest rates they pay with the debt? Credit cards, for example, today have some of the higher rates of interest out there. And if you're lucky, you'll pay maybe 10% for a credit card debt. But more often than not, you'll probably pay 15%, 18%, or even more on a credit card debt. So over the life of your purchase, over a 3 or 4 or 5 year period, if you're going to pay that debt if you'll repay it in small amounts, maybe if you use the minimum monthly payment every month, you very well wind up paying 30, 40, or even 50% more for that product than you would have had you paid cash up front. I looked up last week, and from my source, it looks like in Kentucky, the average credit card balance is $4,521. A little bit lower than the national average. Nationally, the average credit card debt is a little over $5,300. Now, if you incur that debt, and you carry that for a full year at 18% interest, you're going to pay over $800 per year in interest payments on that debt. And that makes these products, whether you're buying a computer or you're buying lunch, it makes it pretty expensive if you're paying that kind of interest to have that consumption today. Many people ask, I'm a new investor. Maybe I've actually never before invested, but I do have credit card debt. Does it make sense for me to invest today, or should I first pay off my credit card debt and then invest in the stock market, or then invest in the financial markets more generally? There are a couple of ways to think about this question. Analytically minded people that like numbers, will look at the numbers and will say, hey, credit card debt is 18%, for some people, maybe more, maybe less. But that's a pretty big number. So if you choose today to pay for credit card debt today, in effect, you are getting yourself an 18% risk-free return. That's a great number. So do that, people say. Other people will say, you know what? Better to form a habit of investing. So take a small amount of money, it's like $1 a day. You can invest that in the stock market, buy a mutual fund, for example. The fund company could, for every month, debit your checking account by $30. Then slowly you can build up a portfolio in the financial market, in the stock market. So people that think that way might say, hey, start small and then slowly build that up. And then along the way, pay for credit card debt. What's best for you, I really can't say. It really depends on your particular facts and circumstances. But think carefully about the debt you have, especially the high interest rate debt, on whether you want to pay that off and how you want to pay that off. In the US, we have primarily 3 credit bureaus, the bigger ones, that for every household, every individual assign a credit score. And that's really a barometer on whether you are a good credit risk or a bad credit risk. If you are a good credit risk, they give you a big number like 800 or something. If you are a poor credit risk, they'll give you a small number, a lower number, like 450 or 400 or 350. Why do you care? Well, you don't in some sense because they never tell you the score. So what your score is, it's kind of hard to know, you have a black box. But you care because lenders that want to lend money to you, or rather lenders from whom you want to borrow money, they care. They look at your credit score, and if your credit score is too low, they're going to not give you credit. If it's high enough, but not super high, they'll lend you money, but at a high rate of interest. So the higher your credit score is, the better risk you are for the lender, the better rate of interest they're going to give you. So in this example on the slide, if you're going to buy a house, the difference in interest rates on the house between a good risk and a lower quality risk might be 1%, might be 2%, might be even more. And that could work out to, for your house, a monthly payment difference of a couple $100, maybe more for a bigger house. End of the day, over your 30-year mortgage, if you are a good credit risk, you will probably pay tens of thousands of dollars less for your house than if you are a lower credit risk. So in that sense, it really matters. Pay attention to it and keep track of what your credit score is. And if you can, take certain steps to improve your score. Here are a couple of steps you can take. My footnote here is this list here comes from the CFPB, the Consumer Finance Protection Bureau, another federal agency, and they deal with things like credit card debt. They've got a website, consumerfinance.org, or sorry, .gov. We can learn more about things like paying off credit card debt and how that affects the personal household balance sheet. While you're reading those, Ms. McCauley, would you mind loading survey number 1 for us? I'd like to do a couple of surveys today, if we have time for it, just real quickly to get a sense on where you stand on certain things. So on my window, a screen popped up. Hopefully on yours did too. A survey, 1 question. These are all going to be anonymous. We are not going to link your answer to your name. Just kind of curious to know overall how people feel about, have you recently invested new money in the financial markets? You bought a stock, you bought a bond, you bought a derivative, you bought a mutual fund, bought an ETF, participated in your 401k plan at work. Let me give you like 5 more seconds. And then at that point, if you could please answer the quiz down, Ms. McCauley. Great. So hopefully everyone sees the response here from everyone. I see on my screen that to the question, have you invested recently new money? Over half, 57% said yes, but only in the retirement plan. 10% said yes, but in non-retirement plans. 1 person got it in both places, and like a third maybe. 10 people said no, but maybe so. I'm happy that no one answered the last the last answer. No one's committed to not being an investor. This to me is one of the key decisions households have to make on the investment journey. I hope to get through like 3 or 4 key choices people have to make. And this is one of them. The first choice is, do you want to invest? Until you say yes, probably you're not going to invest. That's a key choice to make. So let me go ahead and close that window. And one of the first things you need to think about when you actually start your investment is, what precisely are your goals? Are you investing for retirement? Are you investing to buy a new house? Investing to buy a new car? Are you investing because you want to leave a bequest? Maybe you want to give some money to the museum when you pass away. Maybe you want to give a bequest to your children or to your grandchildren. I would encourage you to think carefully about what you want. Be specific. I want to accumulate this many dollars at this point in time for this purpose. Once you know exactly what you want, for what purpose, over what time frame, that helps you make better decisions today, in particular with 2 things. Number 1, it helps you understand today how much money you are going to have to invest to accomplish that goal. And number 2, it helps inform your decision on what type of assets are reasonable for your goal, for your horizon, for your intended purchase in the future. The Federal Reserve Bank in Minneapolis, every year, they do a survey of U.S. households about finances. And they started this, I think, 5, maybe 10 years ago. They got some publicity about 5 or so years ago, because on that survey, one question is something like, I'll get it wrong here, but something like, if you had an unexpected emergency of $400, for example, your car broke down, You need to fix it to get to work. Or maybe a toothache, you need some dental work on your teeth. $400 in an emergency, could you pay for that quickly without undue burden? Or do you have to like go to a relative, go to a neighbor, go to a bank, go to a loan shark to get money for that unexpected $400 expense? The last survey came out, I think this past June, maybe July, and the survey result was fully a third of Americans can't fund a short-term emergency expense of $400. Think about what you can do to make sure in your household situation, you can fund certain expenses like that come up once in a while. Also, when thinking about your long-term goals, if you're thinking about goals like retirement, like a bequest, or a home purchase in 10 years, or a car purchase in 5 or more years, don't forget to also think about the effects of inflation. I mean, over time, dollars are worth less and less. You can buy less with it. Your saved dollar, your invested dollar, is worth less in 10 years than it is worth today. People today, I think, younger people today, looking back over the last 10 or 20 years in the US, inflation has been, it varies a little bit, right? But say 1 or 2, maybe 3% per year. And you might be thinking, well, 1 or 2 or 3% is no big deal. But over a 10, 20, 30-year time period, even 2% of inflation becomes a big number over a long time period. Cars over the last couple decades, 2.5 decades, maybe have gone up in prices by doubling in this example here. Older people, if you're old like I am, or older, you may remember back in the 70s and the 80s. This surprises, my kids don't know this or don't appreciate this, but in the 70s and the 80s, inflation in the US was double digits. We had inflation on the order of 10, 11, 12, 13 or more percent per year for several years there in a row, or almost in a row. Now, I can't predict the future. I have no crystal ball, but if I were 25 years old today and I wanted to invest for the future, like my retirement down the road, let's say 40 years, in a 40-year period, if inflation is 1 or 2%, still it adds up over 40 years. But if we have in the future another period where we have inflation of 10, 11, 12, 14%, if that were to happen in a couple of years in a row or more years in a row, that's devastating to the purchasing power of your portfolio. So think about that as you invest to make sure that your investment over your window keeps up and hopefully beats inflation. Ms. McCauley, would you mind loading survey number 2. By the way, we'll do like 6 of the surveys today, and but for one of them, none of my surveys have right answers. Strictly your opinion, your views of the world and of yourself. So this survey here is for the next 10 years, US equities or US stocks will do how well, per year. If you're to annualize your estimate, like what percent per year do you think stocks will do in the next 10 years? What's your view? Again, no right answer. Your guess is as good as mine. So what are your thoughts? Okay, let's stop with that. So, okay, I hope because everyone see the answer there. Hopefully, everyone can see the answers of what everyone else said. Most people, over half, said between 5 and 8%. Some people, maybe a quarter, said 8 to 11%. Some more optimistic, over 11. Only one person said less than 0. I didn't define real. So real return, by real, I mean not real as in like not fake, but real, I mean real as in nominal. So in finance, there are 2 words to keep track of when you think about returns. One is real return and one is nominal return. So in a given time period, you have an asset that returns 10%, but if inflation was, say, 4%, then the real return is going to be approximately 10 minus 4 or 6%. So the real return is the after inflation return. So one person said after inflation will have a negative return. One person said after inflation will have a 14% return. Those are two very different views of the future. Now, which is right, which is wrong? I have no idea. Let's wait 10 years and find out who made the better guess. There's no way of knowing, but for waiting. Let me close this then. I'm going to do a number of examples here that involve future portfolio growth. And my examples are, if I can get the annotation to work correctly, let me try. I will do blue because blue is Kentucky. This here example assumes a 7% growth rate. Now, is 7 too high or too low? I don't know. But this is the number I pick just to make a concrete number for these numbers, to have numbers to talk about. When talking about a future portfolio, there are three things that matter. Number one is, what is the return of my portfolio? Number two is, how many dollars do I invest? And number three is, how much time do I have? So in this example, I'm assuming a 7% return. The time is 40 years, and my investment is $100. So I'm going to every month for 40 years make an investment of $100 in an asset that returns 7%. Now, is this realistic? Well, no, because no asset in the world delivers a return of 7% per year every year for 40 years. So it's fake in that sense, right? But just to illustrate the value of portfolio compound growth over a long time period, I picked 7%. Next time, part two, in November, we'll talk about risk. So ignoring risk here, the rate changes from period to period. But over this 40-year period, which again is a little fake, a little far-fetched, $100 a month is $1,200 per year times 40 years is $50,000 contributed. So that's $50,000 there. My portfolio, though, grows into the red line, which is $240,000. Let me call that $250,000 just to keep it simple. So over this 40-year time period, I can turn $100 a month into approximately $250,000. When do I earn? When do I really make money in this example? I get a percent return every year that is 7%, but when do I earn my dollars? If you look here at the chart over here, let me change colors. If I were to be, how about pink? Over at this end, I am not earning many dollars every year, right? That first $100 on the very first month for a full year, 7%, I earn $7. That's not much money at all. So year to year to year, I don't earn much money. But here at the end, let me change colors to green. Like right over here, how much is that? I don't know exactly, but that's roughly, by the way, I failed art school. I'm a lousy artist. So don't laugh at me here too much. But that's something like $221,000. That's kind of a big number for me. Multiply that by 7%, right? I'm going to be earning over $14,000 in returns in that last year in this portfolio. Okay, that contrasts with the $7 early on. So when do I earn dollars? Let me change colors one more time, do orange, just to make this kind of a messy slide here for you. Let's look at 30 years. So 30 years is right here. And again, I can't draw a straight line no matter what, but pretend it's over here somewhere. So in 30 years, what's the portfolio worth? I don't know, something like $115,000, maybe $119,000, somewhere around there. Compare that with this number, $250,000. Right? In 30 years, I have roughly half of the portfolio value. In other words, in the last 10 years, my portfolio doubles in value. In other words, I make most of my money in the last 10 years. That's the value of compound interest. The value of my investment comes at the end of my horizon, not at the beginning. a lot of young people, my kids and people their age, they say, you know what, Dad, I just bought a new house. I just bought a car. I've got to buy new clothes for work. I've got to buy fancy meals at restaurants. I've got to go to the concert. Lots of ways to spend money. So I can't afford to invest. Investing is for old people. Young people like me, we can't afford to invest. We're too poor. To them, I say, what they miss out is that the value of investing comes from being there a long time. So if at age 25, you decide I'm too poor to invest, I'll wait until I'm 35. Let me change colors one more time. I'm going to change colors to what's left here, purple. If I wait until age 35 to start, what do I lose? I don't lose the first 10 years of growth, really. And in fact, what I lose is the last 10 years. So if my kids choose to wait until age 35 to invest, their portfolio will be literally half what it would have been had they started at age 25. Okay, let me show that here in a table. Hopefully, let's see, clear all things. Okay. Look at the first column. I'm trying to accumulate, say, my goal, I can have many goals, but suppose my goal is to get $250,000 by age 65. Suppose today I'm 25 years of age. That first cell, $104, that's how much money I need to invest today. I better color this too. Hope you don't mind. More colors. Well, I'll do red. Again, I'm assuming a 7% growth rate. Is that realistic? Well, no. I'm ignoring inflation, maybe. Maybe I'm ignoring taxes, transaction costs, whatever else. But just pretend here for sake of discussion. If my portfolio grows at 7% per year, and if I want to accumulate $250,000 at age 65, and if today I'm 25, then how much must I contribute every year to my investment to get that $250,000? Well, the answer is $104. Now, if I'm too poor at age 25, I postpone by 10 years. At age 35, how much money, whoops, mouse went crazy. How much money must I accumulate or invest every month at age 35? So my period went from 40 years down to 30 years, so 1/4 lower. So I shouldn't have to invest much more money, do I? Well, the answer is I do. I have to invest more than twice as much to accumulate the same $250,000. And if I wait 10 more years, I still feel too poor at 35. At age 45, I have to invest 5 times as much money. And if, heaven forbid, I wait 10 more years and don't start till age 55, then to accumulate the same $250,000, I have to invest 15 times as much money to get it. So again, portfolio growth comes from 3 things. It's asset returns, it's the dollar amount invested, and it's time. Now, everyone, whether young or old, rich or poor, we get the same market return, say 7%, but we differ in the other 2 dimensions, right? So older people have, on average, higher paying jobs, bigger incomes, right? But younger people have, of course, more time. So think of time as an asset. If you're young, you've got it. Don't squander it, because once you wait until age 35 or 45 or 55, that's gone forever. And the only way at that point to make a big portfolio is through a big dollar investment. So time's an asset, young people. And if you are older, you make up for it by making a bigger contribution. Number 1. Number 2, by all means, tell your kids about it. Tell your grandkids. Help younger people to see that time is an asset, and don't waste it. So with that, then, let me go on a little more quickly here. In my day job, I don't use Zoom very often. I'm used to other software. There we are. Oops. Now, if I'm 25, which I'm not, I'm way over 25, but if I were 25 save for retirement for 40 years? The answer is I need to invest $104 a month, or if I want $500,000, $209 a month, or if I want $1 million, double that again, invest $400+ But I have to invest every month, every year for 40 years. And I got to tell you this, my brain is too small. I can't possibly remember every single month to do that. I've got a job, I've got kids, I've got to mow the grass, I've got to make dinner, I'm just too busy to keep track of this every single month with perfection for 40 years. I'm going to forget. What I can do is automate my investment. Most mutual fund companies out there, I want to say all, but probably not, maybe not quite all, or maybe all, I don't know, but many, I think most will set a plan for you where every month they debit, I think at no cost usually, maybe always, your checking account, say, whatever amount you pick, 25 a month, 75 a month, 1,000 a month, whatever. And every month they debit that and invest it in your fund on your behalf. That makes it automatic. I don't even think about it, and it happens whether I'm there or not. That's a great way to automate your investments to make sure they accumulate and they grow over the years. One more survey, Ms. McCauley, number 3. This is a question on how you choose to invest. Do you invest in stocks and bonds? Do you invest in mutual funds and exchange traded funds? Do you invest in things like real estate or somewhere else? So just like choose one, like where does most of your money go? And of course, some people will invest in multiple ways. On average, if you were to invest another dollar tomorrow, where would it go typically? Oh, neck and neck tie here for the first two. Let me close that and then share the results. So actually, we're tied now. It would end up a tie. 15 people said stocks and bonds, 15 said mutual funds and ETFs, 1 said real estate, and 7 said elsewhere. There are many places to invest, is the point here. It could be the stock market, could be the bond market, could be the money market. You can invest in commodities, in precious metals, in real estate, lots of places to invest. Do what's best for you. Different people, based on your facts and circumstances, are appropriate in this place or that place. Let me talk for a few minutes, though, about what stocks and what bonds are. Let's stop that. What are stocks? In a nutshell, if you own a share of stock, you are a part owner in a company. If the company has 1 million shares outstanding, if you own 1 share, then you own 1/1,000,000th of that company. If stock price goes up, you have a paper gain. If stock price goes down, you have a paper loss. You don't actually make or lose money per se until you sell the stock, and then if you sold it for a higher price than purchase price, you have a realized gain, or on the other side, a realized loss. Some stocks pay dividends. Dividends might be, for example, 10 cents per share. Those that pay dividends typically pay them once a year, maybe quarterly, maybe monthly. That's less common. Typically once or twice a year, perhaps, but that varies based on the firm. But typically, the dividend-paying stocks are going to be older, more established, longer-lived firms. New, fast-growing young companies rarely ever paid dividends. As an owner, you get to vote your shares and vote in certain governance issues over the company. Typically issues like the board of directors and major issues of corporate policy. Risks include, the share price can go down. If you bought the stock at, say, $15 a share, could the price fall to 12? Yes. Could it fall to 7? Yes. Could it fall to 3? I'm sad, but yes. Could it fall to $1 per share? Oh, for sure. That happens not every day, but that happens. That's not unusual. Could the share price fall all the way down to 0? The answer is yes, it could. Could it go below 0? If you buy a stock, could the stock price go below 0? So think of a company, for example, that is like, think of it like a factory. Suppose the factory blows up and things get damaged, the neighboring properties get damaged, and there's no money left in the company. Can the company pay off the lawsuits for all the damage made to the neighbors? Suppose they can't. There's still excess liability for the neighboring property that got damaged. Can the neighbors come after you, a stockholder, a part owner, and demand money from you? And the answer is no. We have what's called limited liability. So when you buy a share of stock for $15, the most you can lose is $15. That's your worst case scenario. You can't lose more than that, which is great news as an investor. What are bonds? Well, in a nutshell, if you own a bond, if you buy a bond, you are lending the money to the issuer. Now, bonds can be issued both by companies and also by governments. Let me here focus just on the corporate context, on companies. Suppose a company wants to build a new factory or build a new website or develop new technology or something. If you want to build a new factory, that costs money. You might want to go to a bank to borrow money, or you can come to the stock market, the bond market, come to the bond market if you are a certain kind of company, big, reliable, trustworthy, a good credit risk. You can come to the bond market and issue bonds. When you issue bonds, people like me and you, retail investors, will go and buy the bonds. Buying a bond means giving the firm money the firm uses to, for example, build a factory or build a website or build an application for your smartphone. The promise is, first off, the issuer will specify an interest rate, also called a coupon rate, and also a time to maturity. So corporate bonds typically mature in like 3 years, 5 years, maybe 10 years. Bonds have a face value of, for example, $1,000. So if you buy one bond, you give $1,000 to the company, to the issuer. The issuer takes that money and then they spend it, they invest it. Factory, real estate, website, they buy a patent, something like that. They promise to pay you after that interest payments, coupons. Typically in the US for corporate bonds, interest payments come every 6 months for the life of the bond, say 10 years. So you know up front, back in the olden days when rates were higher than they are today, corporate bonds might have paid, for example, a 5% coupon. So in that case, 5% of 1,000 is $50 per year. So the corporation would pay a payment of $25 every 6 months for the 10-year life of the bond. So that's the predictable cash flow you get from the bond issuer. And then when the bond matures in 10 years, for example, the firm will pay to you the $1,000 principal back. So unlike a home mortgage, if you buy a house, you're the borrower in that case, every month you're paying principal and interest. Bond issuers in the corporate context pay interest and no principal. That's why when it matures, they pay back that full $1,000 they borrowed from you initially. All kinds of risks here, right? One risk is the firm goes bankrupt. In that case, you might lose 10 cents on the dollar. You might lose 30 cents on the dollar. You might lose everything, in fact. Could be totally worthless if the issuer was bankrupt in a certain context. One of the big risks you face here as a bond investor is, I call it more broadly than inflation risk, just interest rate risk. Suppose you're in the market and you just bought a bond today from an issuer, and that bond has a 5% interest rate, 5% coupon. Suppose in a week, newly issued bonds, because interest rates go up in a week, pretend, newly issued bonds issue bonds at a 7% coupon. Then in 1 week, when new bonds yield 7%, who wants to buy your bond at 5%? The answer is nobody. Why buy your bond from you when new bonds yield 7? So for you to sell your bond in a week, which you can do, but you just can't sell it at 5%. You have to change the price of the bond. And which way does the price change? Do you raise the price or do you lower the price? You have to lower it, right? Because no one wants your bond. So to make your bond attractive, you have to lower the price. So that's a key insight. If interest rates go up, your bond, to be marketable, to be able to sell it, must go down. Vice versa, if in a week rates go down by 2% from 5 to 3, then everybody wants your bond because your bond pays a higher coupon payment every 6 months. That makes your bond more valuable. So if you're going to sell in a week in that scenario, you can raise the price. So if yields go down, price goes up. There's a fundamental seesaw, teeter-totter between bond prices and bond yield. If one goes up, the other goes down, all else equal. Ignoring things like bankruptcy and weird things. But just in general, in the marketplace, that's what happens in a fixed income market. Prices and yields move in opposite directions. Mutual funds. Instead of buying stocks and bonds directly, you can buy them indirectly by way of a mutual fund or an exchange-traded fund, more commonly referred to as ETFs. Simply stated, a mutual fund is a company that invests in other companies. So I can invest in a mutual fund. I can give the mutual fund, say, $100. And then when I do that, the mutual fund gives me shares of the fund. The mutual fund then takes $100, goes to, for example, the stock market, if it's an equity mutual fund, and buys stocks for the portfolio of the investment company, of the mutual fund. So as the stocks change in values, up or down, the mutual fund value also changes up or down. So that I, on paper, make profits or losses up or down. Mutual funds are widely available in corporate 401k plans and corporate 453 plans, or 403b plans, 457 plans. So for many investors, their first investment is actually going to be through a 401k plan in which they buy mutual funds. Some corporate pension plans offer stocks and bonds directly for purchase, for investment, but most don't. That's a little bit unusual still. ETFs are like mutual funds in the sense that they too are investment companies that invest in underlying assets like stocks and bonds. One key difference from our standpoint as retail investors is mutual funds trade once a day. If I go to my broker and say, buy this fund for me at 10 a.m. or 11 a.m. or 2 p.m. or 3 p.m. or at 3:59 p.m., whenever I put in the buy order to buy fund shares, all those trades happen at the same time, 4 p.m. that night. And I get the 4 p.m. price normally when I buy them directly from the fund company. ETFs, by way of contrast, they trade in the stock market more like stocks do. So when I buy ETFs, again, these are fixed portfolios of stocks or bonds. I get the 10 a.m. price or 11 a.m. price or the 1 p.m. price or the 3:30 price. Those prices will be in general different. So that's one key difference between the two. Survey question number 4, Ms. McCulley, please. I'm curious to know whether you, as an investor, invest actively or invest passively. So on the news, TV, radio, stock market, you hear things like stock market went up today or the market went down today. Okay, what does that mean? An active investor is an investor who wants to actively beat the market. If the market went up this year by 7%, their goal is to make more money than that, go up by 8 or 9 or 10 or even 20%. That contrasts with passive investors. Passive investors just want to match the market. The market went up by 4%, they want 4%. If it goes up by 10%, they want 10%. As weird as this may be, it is kind of weird. If the market goes down by negative, it goes down by 5%, they want to also go down by the same percentage point. So I'll give you a few more seconds to add in your answers. You're not quite done yet. I think most people are done, it looks like. Okay, let me end the poll now. So it looks like 7 people are active, 20%, maybe half of the audience is passive. Some do both, and some are confused by the difference. And that's fine. I didn't give a very good explanation, perhaps. But this, too, is a key question you have to make if you're going to invest. If you buy stocks and bonds directly, or if you buy a mutual fund, or if you buy an ETF, before you buy, understand if this is an active fund or a passive fund. It's a big, big difference. It really matters conceptually on your view of the investing landscape. Many people, for good reason, choose to be active investors. Many people, for good reason, choose to be passive investors. So think carefully about what's best for you and make your decision. I'm going to stop that. I say that in part because I think I may be out of time for this one. If you go into your favorite search engine and type in FINRA Fund Analyzer, or just Fund Analyzer by itself, you should very quickly get to the FINRA website, finra.org. And on that, there's a tool to give you some free information about mutual funds. Actually, let me show you here really quickly. I'm compelled to show you this tool. Kind of hard to find here. It'll be quicker to go to search engine and type in Fund Analyzer. But if you go to the FINRA site, it's confusing. Over here on the right is a For Investors button. Then if you click on that and go down, you can find, where is it? It's under Tools. It's hard to find. So try your search engine first. There are a couple of tools here I want to talk about. This is the Fund Analyzer tool. You click on that. Here you can type in your favorite fund. And my favorite fund, I can't tell you because I don't give advice. If I give you a name of a fund, you may think this is a good fund or a bad fund. I can't do that. So if I were simply to type in the word, let me just say a word, fund, I will pick, I have no idea, this is my first time ever doing this. What fund pops up first? I'll pick that fund, click Fund Details, and then there's stuff here to look at, but over here on the right-hand side is a big button that says Analyze. Push on that, click on that, and that tells you a little bit about the fund. Now, FINRA.org is a credible source for reliable, trustworthy, accurate information about the financial markets, and it's free. So a bonus there. This to me is a fun page because this shows me the expense ratio for my fund and how it adds up or compares with other funds. First off, in the prospectus objective, or based on Morningstar ratings, or based on Morningstar categories, and how my fund fits in. But based on my objective, which is, what fund is this? This must be a bond fund of some kind. This fund has lower than average expense ratios. So the expense ratio here, the cost to own this fund is 0.16%, whereas for this category, this class of funds, typically it's higher, like 0.58% to own that fund. Okay, going back to the main slides, that's important because whenever you invest in a fund or an asset, you're going to pay a fee for that investment. So make sure you understand your fees and know whether the fee for you is too much or too little. Let's quickly do this. My last survey for the day, number 5. If I have $1,000, if I invest that for 40 years, that's 7%, I'm going to wind up with, again, that's fictitious, right? Because no one gets 7% per year guaranteed for 40 years, but pretend, fantasy, Walt Disney, fairy tale. If that happened, I had at the end $15,000. Suppose instead of getting 7% per year, a typo here. There's a typo in my question. Sorry, I typed it wrong. The question is, what fraction of the final portfolio is lost if 1% in fees were paid every year? This is 15 fees. I had a bad finger here. It should have been 1%. If I pay 1% in fees on this investment per year, every year, how much smaller is my portfolio in 40 years? So don't get a calculator out, just your intuition, just guessing. Intuition, how much do I lose over my 40 years if I pay 1% in fees per year? With a calculator, you get the actual answer here, but just your intuition, what does your gut tell you? Okay, I'm going to end the poll now a little bit prematurely. Sorry for cutting you off if you weren't quite finished. But here are the results. So the first one makes sense because if I pay 1% fees, I have 1% less money, right? That's option A. Option D, the last one is, well, 1% per year, 1% times 40 years, so I lose 40%. That's almost half the portfolio. So that's why you might want to pick that one. Option B, if I earn 7%, right, and if I pay 1/7 of that, 1% to fees, I should lose 1/7 of my investment, right? I think 1/7 is 14% roughly. So shouldn't I then wind up with 14% less at the end? That's option B. And then option C, why would you pick 1/3? I have no idea. That's a random number, but it happens to be true. So the correct answer is C. So all the rest, there's no right answer, but for this one, the right answer is 1/3. Think about that for a second. That should be for you very surprising. I'm actually quite surprised that 14 people picked that answer. You have phenomenally good intuition, or get a calculator, one of the two. But for most people, for me, for most people, that's a surprise, right? So think of it as fees matter, and the longer you're there, the more they matter, right? Earlier we talked about compound interest. Think of compound fees. For every 1% in fees you pay this year, you have 1% less next year, and then 1% less the next year, and the next, and the next, and that compounds because you did not invest that to compound for your benefit. So it's compounding for the other side's benefit. Now, of course, it's reasonable to pay fees. You have to pay fees. No one works for free, so by all means pay fees, but be mindful that fees matter. Many people think a 1% fee doesn't matter. Small potatoes, ignore it. This example illustrates over a 40-year horizon, which is a long time, granted. Over a 40-year horizon, you lose 1/3 of your ending balance by paying a fee that seems small, like 1%. That's the point there, just that. Let's see, back on track. Did fees, skip that, skip that. A couple quick tips to avoid fraud. Fraud's a big thing for the SEC because every year, every day, someone out there wants to steal your money. So what are they going to do? Things to look out for, red flags of fraud. When someone says, guaranteed, this is a low risk, no risk investment, I will double your money in 2 months. I will double your money in 1 year. Invest with me and you will get 50% guaranteed in 1 year. You have to invest today. You won't be here tomorrow. No, I have nothing to give you in writing. There's no prospectus. Sorry. Just trust me. The person you're talking to is not licensed, is unregistered. Okay, these are red flags of fraud. And no legitimate investment will double in 6 months. Now, in the past, right, some stocks in the stock market did double in 6 months, but that was not guaranteed, right? That was high risk, worked out well, but high risk strategy. There is no risk-free way to make gobs and gobs and gobs of money in a short time period. When people call you unsolicited to offer things to you, be wary. Now, maybe it's legitimate, maybe it's a real investment opportunity, maybe you want to invest there, but maybe not. Think carefully. By all means, when someone calls you, emails you, you hear on the radio, direct mail something, stop, think about it, get some advice. Talk to someone else, talk to your friend, talk to your relative, talk to a professional that you trust, and get advice before you invest. Every year, there are lots of people that give their entire portfolio to some scammer because he says, I will double your money risk-free, 6 months guaranteed. When you are 65 years old, 70 years old, you're retired, when you give your entire nest egg away, it's gone, and you've lost it. And then what do you do? That happens every year in the US stock market today. Be careful. Don't let it happen to you. Go to the SEC website, and actually right here on the homepage. So this is investor.gov, a great place to go to learn about investing. This is run by the SEC, and a lot of information both for novice investors and also for experienced investors. This middle piece right here, you can type in a name like George Washington, and you can look up people that are licensed with the SEC or with FINRA, whoever this person is, and learn about them and if they're licensed or not. If the person you're talking to is not licensed, go somewhere else, because anyone that's selling investments, securities, stocks, bonds, mutual funds, ETFs, they have to be registered. And if they're not, that's a red flag. Go somewhere else. Resources, the website. On that website, a number of tools. The very top of the page, there's a link in the blue box called Financial Tools and Calculators. A lot of resources that people like. That's some of the more popular pages on the website. We also have on the website a lot of alerts and bulletins to tell people about things that are currently in the news. Read about them. Let me end with this slide. I am speaking on behalf today of the Office of Investor Education and Advocacy. We do a number of things. One part of the office does this, investor outreach. We go around to different groups, to extension, to public libraries, to senior citizen centers, to investment clubs, and talk about investments. Another group makes the website, and then another group has an actual phone bank. Here's their phone number, 1-800-732-0330. Again, 800-732-0330. And also an email account, help@sec.gov. If you ever give your nest egg to someone who steals it from you, like what do you do next? Call this number and ask for advice. A real person will answer the phone and it'll help you figure out what to do next. Can we get your money back for you? Don't count on it. If you give your money to a fraudster, that money might be gone forever. Maybe not, I don't know, it depends. But maybe forever. So before you invest, understand the risks and be careful. Make sure the person you give the money to is licensed, is registered with the SEC. We've also got a website. I mentioned that. Got Facebook, got Twitter even. So we try to be reachable in different social media platforms. And with that, I think I'm done. Dr. Huff, let me turn the baton back to you for Q&A if anyone asks any questions along the way. I'm happy to answer questions.
Yes, well, thank you so much. It's so much information, and I know if you're like me, you're probably digesting it all. And so we thank you for the websites and the links. And again, Dr. Johnson will be sharing these slides with us. We'll be sending them out to you so you can reference things like the SEC website and FINRA website. And so it will have all of the links. But yes, we did get some questions, and there were a couple on how to avoid paying fund fees. And so if you're working with a financial advisor, if you do pay that 1% in fees, how do you avoid that? And so can you speak to that?
So everyone wants to make a living, right? If you want to hire someone to work for you, they want to not work for free, right? We're so used today to the internet where we can go online and get these services ostensibly for free. But real people with real jobs don't work for free. So I'm not going to say, avoid people that charge a fee, because they're professionals. They've got training. They went to college. They have a degree, maybe a master's degree. They've got some certifications, some experience of education. So don't be scared of fees, but know their fees. Ask them, what are your fees? And make sure you know what the fee is. That's the fee you feel comfortable paying. There are different ways to pay the fee based on whether the person you're working with is a stockbroker, for example, or an investment advisor. Yeah, you can shop around. People charge different fees, and they should charge the fees transparently. So when you first meet someone, a stockbroker or an advisor, an early question should be the first visit, or maybe the second one, but maybe the first one, for maybe the first one, what are your fees? In particular, how are you compensated? Um, if the number is really big, if it's scary, then shop around, look around. Maybe you'll find a better package of fees for services that you value, right? So the fee has with it services. Maybe the fee is big because that firm, that person gives lots of services, and maybe you're happier with you're content with fewer services, so you can maybe get a different bundle somewhere else. I think that's my answer, Dr. Ruff.
Okay. Someone asked, is a money market fund and a mutual fund the same thing?
Yes, broadly speaking. Sometimes you hear the term money market mutual fund, and for whatever reason, technically the word mutual shouldn't be there. It's a money market fund, and the money market funds are, in fact, mutual funds. Mutual funds can have different objectives. Some mutual funds invest in domestic stock, some in domestic bonds, some in international stocks, international bonds. Some in just certain segments of the economy. For example, an equity fund that invests only in technology stocks or only in manufacturing stocks. But a certain class of funds is called a money market fund, and those funds tend to be very conservative securities that want to maintain a stable price and be very, very safe for you. Effectively, they buy things like very short-term treasury bills or a thing called commercial paper, which is beyond the scope of this lecture today. But this is kind of like, not really, but kind of like a bank account, but a little bit more risk and a little bit more return, usually, not always. Banks are FDIC insured. Credit union accounts are usually, NACU or something, insured. But money market funds are not insured. You invest $1, you could lose money, but historically, people don't lose much money at all in money market funds. So yes, they are mutual funds. That's my answer.
Okay, great. So we had another question about micro investing. And so how do you feel about micro investing, like Robinhood or Acorns or Stash? Is any investing good, or is there a concern about not investing enough?
By micro investing, I think you could mean I invest in small cap stocks, or you might mean I invest small amounts of money. Maybe the latter?
I think the latter.
The latter, okay. So I can't comment directly on things like, you mentioned some specific firm names there. I don't want to comment on specific firm names, but I would say if you read the newspapers, the financial press especially, in the media often there are stories about things like cell phone based applications that allow investors to buy and sell trade stocks through their cell phone. And you'll come across articles where different commentators say that's a great resource, a great tool, there should be more of that. And some commentators say that's a very caused me some concern because maybe it will make people trade maybe too often, or maybe the wrong kind of securities, maybe at the wrong time. It's risky. People could lose money. Some of these applications, maybe some people say, encourage people to like trade just like too aggressively in a way that hurts them. My chairman actually has been in front of Congress and testified on this issue, the kind of questions before. And so I will not speak on his behalf. And I'll simply say, as a general matter, for many people, investing is a good thing to do. Not for everyone. For some people, for sure, they should not invest. But for many people, the answer is yes, you should. So consider carefully for you whether these cell phone applications are good for you or bad for you. Do they make you want to trade too often? If they do, maybe you're better off somewhere else. In terms of small dollar amounts, many mutual funds do not have a minimum initial investment. Some do. Some funds say that to invest in this fund, you have to invest no less than, say, $500 or maybe $1,000. There are a couple of well-known fund companies where to invest, you have to invest no more than $1,000 at a time. And for many investors, that's too much. That's too big. But many fund companies, you can invest for as little as $25. Call it $1 a day. So to me, that's micro investing. You can invest in a real legitimate mutual fund by $1 a day, no problem, through their automatic investment plan.
All right, so we knew this question would come up, Dr. Johnson. So we have been asked about Bitcoin and cryptocurrency. And so can you speak to that at all, your opinions, or is it investable? Or so how can you address cryptocurrency?
Well, I can't say very much, and I really can't say much of anything on that issue. Invariably, people ask about that because that's very trendy, very marketable. It's in the news. Some of these things, I'm very careful here. I don't want to say the word security or the word asset because security is a word that has certain legal implications. Let me avoid those kinds of words that say things, just to be a little more vague here. But these things have been in the news often. And some of these things, their prices are big. They get really high really quickly. They get really low really quickly. Like, what does this mean? And many people really want to invest in some of these things. They're very topical. I would say regulators are very mindful these things exist. If you read the newspapers, you'll see articles all the time from regulators like the SEC, like the US Treasury, like the Federal Reserve Bank, internationally too. In the UK, Japan, Paris, Saudi Arabia, everyone cares about these things. They're taking action at different rates across the globe. At some point, the U.S. regulators also will take action. Maybe not. Who knows? I can't say. I don't know. Not my role. But I would say for any investment, be careful, understand the risks, and be mindful that whatever you invest today, sure, the price may go up tomorrow, but also might go down. So are you okay with that? That's my answer. So it's kind of a lame answer right now. Be careful. Be careful.
Well, I will say this, and what we always say is, never invest what you can't afford to lose. And so I will speak to extension. And so Kelly May is up here. Our team has a publication, extension publication that should be coming out any day now on understanding cryptocurrency. And so if continue, we will be sure to share that with this group when it does come out. If you want more on just basic understanding, again, not advice, but education on understanding cryptocurrency and the risk, and especially fraud risk. So I'll put that plug in there. Okay, so what is the difference between front-end load fees versus back-end load fees for mutual funds?
Big difference. I could talk for hours about this question. Let me try to be concise. It's hard to be concise because I can share so much. Big picture, mutual funds, there are two big classes of funds. One class historically we called no load, and the other class we called load. Historically, if you go, so mutual funds were first created or developed or built back in the 1920s. The first fund, I think, was launched in 1926 or 24. I don't recall for sure. But back in the olden days, back in the 20s, 30s, 40s, 50s, all funds were load. And what that meant was you bought them through usually a broker. And when you bought the shares, you gave say the share price of the fund was like $20. You pay a little bit more than that to buy the fund. You pay $20 and something else, maybe $20 and say 50 cents per share. And that 50 cents is the load that doesn't go to the fund portfolio per se, but goes to the broker that sold you the fund shares. In the 1970s, I don't recall the year, I think it was the 70s, when no-load funds became, when they were created, when you can go directly to the fund company itself and buy shares not through a broker, but through the fund, and buy them at the real price of the fund, at the NAV. Today, there's a mix of both. For funds that have load shares, for a loaded fund, they have what are called different share classes. Traditionally, we had share classes A, B, and C. Today, there's a whole bunch of share classes. There are some fund companies today, some mutual funds that have literally dozens and dozens of share classes. But to be simple today, you talk about front-end load versus back-end load. Traditionally, front-end load were Class A shares and back-end load were Class B shares. I'll make up a number here. It varies from fund to fund, but a front-end load might be a number like, say, 5% or maybe 6%. They're capped. I think the current cap is, actually, I don't know. I think it changed. But if you went back to the 80s and 90s, the maximum front-end load was 8.5%. It might be lower today, I'm not sure. But in any case, today, though, loads are typically numbers like 5 or 6%. So when you buy a fund today, a front-end load fund, share class A, you're going to pay the price of the fund plus, say, 5 or 6%. And that 5 or 6% goes to compensate the person who sold those shares to you. Call that a stockbroker or an investment advisor. You hang on to those fund shares for your preferred holding period. Could be 1 week, 1 month, 1 year, 10 years, 30 years, whatever. You've paid the load, you're done. In the future, you sell the shares at NAV, at the share price, take your cash, and then do your thing with it. That contrasts with back-end share loads, Class B. And for those shares loads, you pay upfront the NAV. You pay no extra fee for the fund. So you buy them at the share price. You hold the fund. If you sell the fund in a year, you pay the back-end load. And the back-end load might be a number like, say, 5%. The difference, though, between front-end load and back-end load is that the back-end load typically will decline from year to year. So if you sell the fund in 1 year, you might pay 5%. But in 2 years, you'll pay 4%. And then in 3 years, you'll pay 3%. In 2 years, 2. The next year, 1 to 1. And the next year, you pay 0. So the back-end load, if you hold the fund shares long enough, you pay no load on either side. If you sell it quickly, first couple of years, you pay a fee, and that fee declines. So the difference is you pay the fee upfront when you first buy, or later on when you sell the fund shares. That's more than you want to hear probably, but that's a quick summary of back-end versus front-end, share class A versus share class B fund shares.
Okay, and so just to give you kind of a barometer of where we're at, we have about 4 more questions that we'll take for tonight.
Okay.
And so one is that I see you skipped the investment apps. I think so you advanced through those slides. Is this something you'll address, and will you keep it in the slides that you share?
I think that was a request, and so given that request, the answer is yes. I'll come back to that.
Great, thank you. Okay, so just now three more questions. So if I am able to live using cash, will getting and using a credit card and paying off the balance in full every month improve my credit score?
Well, I am not the credit bureau, and so I don't see their formula. But I think the common advice people give is that the credit bureaus give you a FICO score, for example, a credit score based on your use of credit. So if you have no credit history, because you always pay cash, you pay cash for your house, for your car, for your lunch, you have a credit history, and so they think they don't know, so they may call you riskier than you really are. So if you do get a credit card and pay off the debt on time, never late, you never carry a balance, that will help your credit score. They'll give you a better credit score on average. So on average, I think the answer is yes. It will help you out for the credit score purposes.
Okay, so this question, one of the 2 that we have remaining is this person complimented you on how you explained the compound interest chart. And then they went on to ask that if they waited to start investing or took out money during COVID, can they gain back some of that compounding interest by putting more in now? So is there a way to make up if investments were kind of shaken up during COVID?
You said taking cash out. So you mean like in a 401k plan, like a cash out?
They didn't specify, but we'll go with that.
Yeah, so if you mean, so a lot of 401k plans, right? You contribute every paycheck, say every week, every 2 weeks, once a month, whatever your pay cycle happens to be. Typically, then on your paycheck, a certain fraction, say 5%, is withdrawn from your paycheck to put in that mutual fund in that 401k plan. Many plans allow you to take a loan against your 401k balance. So in that case, I would say talk to your human resource department about what the rules are around that loan. When the loan comes out, you got to pay it back with interest. And I don't know what the interest rate is for your plan. And that rate, I think, changes based on IRS rules from year to year. So what it is currently, I don't really know actually. But I don't think you can contribute. You pay back what you borrowed plus that interest rate on the loan, and you cannot put back more in, I don't think. So I would say if you want to put more in, well, you probably can't, but check with HR to make sure. But if they tell you can't, then by all means, you're still free to open up an account on a taxable account and invest outside of the plan. So it's sensible in some sense to have, if you already have a 401k plan at work, then why not open up a taxable account? Call that a taxable mutual fund account and buy mutual funds, or a taxable stock brokerage account and buy stocks, whatever you prefer to do. But by all means, it's reasonable for sure to have a taxable account on your own. And in that account, you can invest whatever you want. There's no limit on a taxable account.
Okay. And so the last question, and then I do want to, so if you're still with us, I thank you. I do have an evaluation slide that I will post here in just a moment. And so please make sure that you click on that link here shortly. But the last question, if you would address tonight, if you have invested for 40 years into retirement and are at retirement age, what is a key piece of advice to keep in mind to protect your retirement funds?
Yeah, that's hard, right? Because when you go online and read finance blogs or finance podcasts or just information about books, invariably these people, the authors, talk about asset accumulation. How do you accumulate assets over the years? And very rarely can you find good information about asset decumulation. So the big picture question is, when I retire, when I leave the labor force, age 65, say, I've got a nest egg, hopefully big, whatever big means for me. In my life expectancy, at age 65, I might live 10, 20, 30 or more years. At that point, how do I spend down my assets? I actually forgot, Dr. Hopp. Could you repeat the question? I got sidetracked there in the background.
Sure. I think it was just a key piece of advice just to help protect your retirement fund. If you're at retirement age, and how do you protect that?
So number one is stay away from fraudsters, because you got a portfolio, they want your money. If it sounds too good to be true, literally run away, because if you lose your money, like, what do you do? So watch out for that, number one. And number two, you think about risk differently maybe when you retire, because when you're working, right, if things go bad in the stock market, well, I just work longer, just don't retire. And I can make up for part of it maybe. But once I left the labor force, it's hard to get back in. So losses maybe mean more to me when I'm 65 and unemployed than when I'm 50 and employed. So maybe I want to be investing in less risky assets. So rather than investing in some darling internet high-tech stock, in those cryptocurrency, whatever they are, maybe I want to be in safer blue chip assets, or maybe I want to hold safer bonds. So typically the advice is, and there's reasons to not do this, but common advice is that when you're young, the portfolio could be weighted more heavily towards stocks. Stocks on average are riskier than bonds are. And as you age, the portfolio could shift more towards bonds. So at retirement age, what's left labor force, portfolio could be, many people would say no stocks at all, but many still would say some stocks, but just more bonds at that point. But overall, the big picture would be, have safer assets, be more mindful of the risks, And yeah, protect yourself.
All right, thank you. And on that note, we are going to wrap up for tonight. I encourage you to snap the QR code, to click the link in the chat box. If you're watching the recording, we would love your feedback too as well. And so we will keep the evaluation up so that we can get your feedback as we prepare for part 2 of this series. And so in 1 month, we have a month in between sessions to give you time to process this information, to research some of the links that Dr. Johnson has shared, and to come back ready to dive in just a little deeper. And it is complex. It is a complex topic.
Yeah.
And so we are so thankful to have Dr. Johnson sharing his insights, sharing his resources with us, and we look forward to meeting back together in 1 month and discussing part 2 of Introduction to Investing. So Dr. Johnson, thank you so much. Thank you everyone for joining us, and we will see you for part 2.
My pleasure. I look forward to seeing you again in a month. Thanks everyone for coming.
All right.
See you then. Bye.
Good night, everyone.